everybody. How are you today?
Fine.
How was your weekend?
Good.
Did you go to the beach? Did you go to the beach?
Yes.
My office were empty.
That sounds good. Because now you can concentrate on your lesson, right? So let's start our lesson today. Today I'm going to talk with you about a very basic accounting principle, which is double entry bookkeeping. So here are the content of our lesson. First, we will have a quick revision of what we have learned last time. And then we'll go on to the main part of our lesson about the double entry bookkeeping. Now first, I want you to have a quick revision of the concept that we have learned last time about the basic financial statement. So there are two basic financial statements for a business, which is the balance sheet and the income statement, from which the user of financial statement can analyze the financial position and financial performance of a business. And then the next concept is the accounting equation. So the total asset must equal total liabilities plus all the equity at all times. And in this side of the equation, you can see the sources of financing for business. And in this left-hand side, you can see the uses of that financing. So now I want to give you a little activity so that you can think about what you have learned last time. Now in your group, please list down at least 10 financial statement items and break them down into the different categories of assets, liabilities, owners, equity, and revenue and expenses. So I will give you 3 minutes for this activity. Right. Now list down 10 financial statement items. Yes. And then break them down into different categories.
Financial statement items.
Accounts payable. Yes.
Visible assets. Yes.
Asset. Visible asset. Invisible. It is an item of asset.
Intangible.
Yes. And invisible tangible asset. Right. So how about revenues and expenses?
Gains. Loss.
Gains, loss,
Revenues.
revenues. Yes. You
Cost
can
of
be
goods.
more specific, like revenues from selling goods and services, right? Or gain or loss on disposal of non-current assets. Okay. So that's some of the terms that you have learned last time. And now I want to give you a list of glossary with the pronunciation. So make sure that you practice them at home and pay attention to the difficult words like inventory or purchase, right? Now we will move on to the main topic for our today's lesson. So this is about the double entry bookkeeping. Now we often say that there are two sides to every story, right? For example, when you go to buy a bottle of water, you pay the money to the shopkeeper, like for example $3, and in return you receive a bottle of water. So you can see that the transaction has two effects. The first one, you pay money, and in return you get a bottle of water. So it is the same in accounting and business. Every transaction has a dual effect on the account of the business. Now, I will show you an example so that you can see that in more details. Let's take this example. Anne has just started a business, and to start, he invested $1,000 in the business. So how does this transaction affect her business accounts? Now, at first, Anne only recorded the cash that the business has, which is $1,000. But then she realized that the book only shows what the company has, but it doesn't mention about the sources of fund, right? So here we need another entry to record the second effect of the transaction, which is the capital of the business. So this $1,000 will become the capital that Anne invested in her business. Now, if we show this in the accounting equation, you can see it more clearly. When the owner invested $1,000 to start the business, then cash increases by $1,000. And at the same time, capital also increases by $1,000. So we call this the double effect of the transaction. And I will give you some more of the transactions so that you can look at that. Let's say in the second transaction, inventory costing $500 was purchased for cash. So you can see in this transaction, there is an increase in cash of, a decrease in cash of $500, right? But at the same time, inventory increases by $500. So this time, the total assets remain unchanged, but still there are a double effect on the transaction on the business account. And in the third transaction, the business borrowed $200 from the bank. And now you can see here, we have an increase in cash of $200. And at the same time, loan amount increased by $200 as well. So in this case, both sides of the accounting equation increased by $200. And if you sum up all the columns here, you can check whether the accounting equation still remain balanced, right? Now we have the asset of 1,200 and total liabilities and owner's equity of also 1,200, right? So you can see that every business transaction has a dual effect on the business bank account. That is, a transaction will affect or will result in changes in at least two different accounts of the business. Now I will give you an activity so that you can have a more practice with this rule. Now here I will give you this practice is continued from our previous example. Here I give you 5 more transactions, and your task is to identify the changes to the accounts of the business. So I will give you, let's say, 3 minutes, right? You can do this practice individually, and then you can check your answer with your partner. Now let's start.
A lot of exercise.
Now this is based on the assumption that you will remember what we had learned last time, right? Now, when we are doing this exercise, you can first you should think about how a transaction affects which accounts are affected by a transaction. For example, when the business purchased inventory costing $200, so which accounts are affected? Inventory, right? Go up or down? Yeah, inventory goes up by $200, right? How about the other side of the transaction?
Cash.
Yes. Purchase $50 on account. This means that $50 will be paid later, and this $150 was paid immediately. So this $150 related to which account? Cash. Yes. So cash go down by $150, and accounts payable will be increased by $50. So you can write down in your accounting equation, like the one we did last time. Here we have cash decreases by $150, inventory increased by $200, and payables goes up by $50, right? So we can do the same for the next transactions.
Excuse me, can you see the table?
I will give you the slide after the class. Now, you can discuss in your group.
Inventory costing 300. The inventory decrease. Yeah, reduce. Within 300. This was sold for 400.
We sell transaction, so separate two things. Sales because of yourself, sales and related expense. Okay. So you have to determine how much sales. So you see here you earn the sales of 400. And at the same time you have an increase in cash and account receivables. And to earn these sales, you lost the control of the inventory. That's why you can that's for cost of goods sold.
So
Since the
please
cost of
check
goods
your
sold
answer
increase,
in the slide
the
here.
inventory will be complicated.
Have you got all the